At 2:13 a.m., Jerome Powell gets the order no Fed chair is supposed to get. Not a rate cut, not emergency lending, something uglier. The Federal Reserve creates $10 trillion overnight. By breakfast, the number is bigger than the entire 2024 federal budget of the United States, bigger than Japan's GDP, almost half of America's annual output, appearing before most people finish coffee. A nurse in Phoenix checks her bank app. A landlord in Dallas refreshes Zillow. Jamie Dimon at J.P. Morgan watches Treasury markets twitch like they've seen a ghost. Everyone assumes the same thing: prices explode. But the real question is sharper. If the Fed printed $10 trillion tonight, who gets richer before everyone else realizes they got poorer? Most people picture wheelbarrows of cash, Weimar Germany, and a carton of eggs costing $90 by Friday. That's the cartoon version. The first crack is that printing money does not hit everyone at the same time. It enters through pipes, banks, bond markets, government checks, corporate balance sheets, asset prices. In 2020, the Fed did not literally hand every American a suitcase. It bought treasuries and mortgage bonds. Its balance sheet jumped from about $4.2 trillion in March 2020 to nearly $8.9 trillion by 2022. And the first things to move were not sandwiches. They were stocks, houses, crypto, and borrowing costs. So if $10 trillion appears overnight, the first winners are not the people who need money most. They are the people closest to the pipe. Look at 2020 through the eyes of Elon Musk. In March 2020, Tesla was in trouble like everyone else. Factories shut down, investors panicked. The stock market crashed 34% in 23 trading days. Then the money flood arrived. The Fed cut rates to near zero. It launched massive bond purchases. Congress sent out stimulus. Credit markets thawed. Risk came back like somebody had unlocked a casino at midnight. Tesla shares rose more than 700% in 2020. Musk's net worth jumped from roughly $27 billion at the start of that year to over $150 billion by early 2021, according to Bloomberg estimates. Did Musk get a $120 billion stimulus check? No. He owned the thing the new money chased. That is the uncomfortable part. A $10 trillion print would probably lift asset owners first. Stocks, homes, private companies, land, Bitcoin, anything investors believe cannot be printed. Now meet the other side, renters. In 2021 and 2022, American home prices, tracked by the Case-Shiller Index, surged more than 40% from pre-pandemic levels. The median U.S. home price went from about $329,000 in early 2020 to over $479,000 in 2022, according to the Federal Reserve Bank of St. Louis. If you owned the house, you called it wealth creation. If you were saving for the down payment, it looked like the ladder being pulled up while you were still climbing. The textbooks call this transmission. Normal people call it being late, and the cruel part hides in the order of arrival. By the time wages adjust, the expensive stuff has already moved. Ask Argentina. In 2023, under President Alberto Fernandez and then the transition to Javier Milei, Argentina lived inside the nightmare version of monetary distrust. Annual inflation passed 200% in 2023. By early 2024, Argentines were changing prices so often that restaurants used QR menus because printed menus expired too fast. But the rich did not experience inflation like the poor. Wealthy Argentines bought Miami condos, held dollars, owned farmland, or stored value in assets priced globally. Middle-class workers held pesos because rent, groceries, and salaries were all trapped in pesos. When a country prints aggressively and people lose faith, the poor become involuntary holders of the weakest asset in the room. And the same mechanism is quietly running in your paycheck right now. If your income is fixed for a year, but your rent, insurance, groceries, and car repairs reprice monthly, you are lending purchasing power to the system without agreeing to it. That's why $10 trillion overnight would not feel like one clean event. It would feel like confusion. Your brokerage app might be green. Your grocery receipt might be violent. Your boss might say raises are coming after the next budget cycle. Your landlord might say the market has changed. And somewhere, a company like Blackstone would move faster than you can. In 2021, Blackstone bought Home Partners of America for $6 billion, adding tens of thousands of single-family rental homes to its platform. Big institutions understood something ordinary buyers felt but couldn't name. Cheap money makes scarce assets more valuable. So the second-order effect is not just inflation. It is ownership transfer. The shocking answer is that $10 trillion might not destroy the dollar immediately. That sounds wrong. It sounds like heresy. But history says confidence can absorb terrifying numbers, for a while, if the world still believes the issuer is powerful. Japan is the uncomfortable comparison. The Bank of Japan spent years buying government bonds and even stock ETFs. By 2023, Japan's central bank owned more than half of Japan's government bond market. Its balance sheet was larger than Japan's GDP. And yet Japan did not become Weimar Germany. For decades, it fought low inflation, not hyperinflation. Why? Because Japanese households, banks, pension funds, and companies still trusted the yen system enough to hold it. Japan also owed most of its debt to itself. So the answer to the question from the beginning is not everyone gets poorer instantly. The first winners would be asset owners, banks, leveraged companies, and anyone who can borrow before prices reset. The delayed losers would be wage earners, renters, cash savers, and anyone waiting for permission to move. But America is not Japan. The US dollar is the world's reserve currency. Foreign central banks, oil exporters, and global companies hold it because they trust its depth. In 2024, the dollar still made up about 58% of global foreign exchange reserves, according to the IMF. A sudden $10 trillion print would test that trust, not because people can do perfect math overnight, because belief changes socially. One pension fund sells treasuries, then a sovereign wealth fund hedges, then import prices jump. Then Americans discover the scariest inflation is not when prices rise. It is when sellers no longer trust your money enough to wait. So what hits your wallet? Not a Hollywood collapse by Friday, a reshuffling. If you hold only cash, your safety could become slow-motion exposure. If all your income depends on one employer adjusting your salary once a year, you are betting your lifestyle on their speed. If you own productive assets, a home with fixed debt, equity in strong companies, or skills you can reprice, you are closer to the pipe than you think. The next 12 months, your real decision is not whether the Fed prints $10 trillion. It is whether your money sits still while everything priced around it learns to run. Cash feels safest right before it becomes the thing everyone is trying to escape. What if the Fed printed $10 trillion overnight? The winners would not be the people who noticed the headline first. They would be the people whose assets, debts, income, and skills were already positioned before the new money changed the rules. If you found this useful, subscribe to What If Finance new video every week.